Brian Jacobsen, what kind of correlation are you seeing in the market right now? Are things going up and down together? And if they are, how dangerous is that?
Yes, things are going up and down together, unless, of course, you're looking at the relationship between equities and, say, Treasury securities. It seems as though every time there's this risk-on and risk-off move in the markets, you see either Treasury, the prices go up while stock prices go down, or vice versa. And that can be a little unnerving for investors, unless, of course, you're properly diversified, and that's really the key.
Well, how does an investor know whether or not their assets are too correlated?
I think one of the ways is just look at your statements on a daily basis. Is it the case that when the S&P 500 is up 1%, is your portfolio up 1% as well? Similarly, if it's down 1%, is your portfolio down 1%? That's a really good indication that you might want to make some tweaks to that portfolio to lower those correlations.
And how can a liquid alternative fund help alleviate the situation? We've been hearing a lot about liquid alternatives lately. They don't perform as well as the S&P 500, but there's a reason for that.
That's right. Yes, liquid alternatives, sometimes it depends on which ones you're looking at. The good ones that I prefer are the ones that are really looking at that risk management, trying to stay uncorrelated to the broader market. And the way in which they do that is by having a variety of strategies incorporated into one portfolio. Now, you could look at, let's say, 4 different types of alternative strategies, but each one might behave very differently depending upon what's going on in the market. But if you mix them all together and try to go for more of a benchmark-free approach, that's where you can better diversify your portfolio. Part of it is you build in diversified thinking into managing the money, as opposed to just focusing on saying, am I checking the box, having my large cap, small cap, and mid cap filled out?
And how much should a person add with regard to their portfolio? How much does a liquid alternative need? How much does someone need in their particular portfolio? What percentage of their asset allocation?
I think it really depends upon the individual, but what I aim for with my models that I run is right now in today's environment, because there's a lot of ambiguity out there about what will indeed happen when the Fed starts raising rates, what will happen not just to the fixed income markets, but the equity market, to the value of the dollar, to the price of oil. I think there's enough ambiguity where it can justify having anywhere from 10 to 15% of a portfolio in liquid alternatives. Now, once that sort of cloud lifts, that ambiguity sort of goes away, I think then you can justify taking a little bit more off the table. A lot of it also depends upon how a person wants to manage his or her money. If you want to, you could actually put a lot in liquid alternatives, provided it's properly diversified. And that's the key thing, is to make sure that your alternative investments are actually diversified.
All right, thanks a lot, Brian.
Thank you.
Thank you for watching The Street.